One of the most important numbers in a childcare acquisition is also one of the least understood numbers by buyers and sellers, DSCR. I'm Brent Delhamer with Childcare Insight. And if you do not understand how debt service coverage ratio impacts underwriting, it becomes very difficult to understand why some deals move smoothly while others fall apart deep into escrow. This is where many buyers and sellers get blindsided. A lot of owners assume if the business is profitable, financing should work. In reality, lenders are usually asking a more specific question. Does the business generate enough reliable cash flow to comfortably support the future loan payments while still operating safely and sustainably afterwards? That is what DSCR is helping measure. In many SBA-backed childcare transactions, lenders are heavily focused on whether the business has enough remaining cash flow after expenses to absorb debt obligations with an appropriate margin of safety. And this becomes critical once underwriting begins. I recently worked on a transaction where the seller felt strongly that the business justified a higher valuation because enrollment remained healthy and the center had a strong reputation locally. Operationally, the business looked attractive, but once the lender reviewed the adjusted cash flow relative to projected loan payments, the DSCR became tighter than expected. The buyer still wanted the center, the lender became cautious. That distinction changes transactions very quickly. Another major misunderstanding is that DSCR is not only affected by revenue. Buyers and sellers often focus heavily on top-line enrollment revenue while underestimating how payroll, occupancy costs, insurance, staffing structure, and operational efficiency all affect debt coverage underneath the surface. Childcare businesses naturally carry substantial operating expenses because ratios, staffing, and licensing standards matter daily. Small shifts in profitability can materially affect underwriting comfort. And the crazy part is that many owners do not fully appreciate how sensitive debt coverage becomes once loan payments are layered onto the business. I have seen centers where gross revenue looked strong initially, but once payment inefficiencies and occupancy costs were normalized, the remaining cash flow became much tighter than expected from a lender's perspective. That created pressure during negotiations almost immediately. And there's another issue almost nobody talks about. DSCR is not just influencing approval. It often influences how aggressively lenders structure leverage. If debt coverage appears thin, lenders may reduce loan amounts, require additional liquidity, increase buyer equity injection expectations, or become more conservative with the overall transaction structure. I worked on a deal where the buyer initially expected a standard SBA leverage, but after full underwriting review, the lender became concerned about the margin compression and future operation volatility. The lender still liked the deal overall, but the buyer ultimately needed to inject additional capital to strengthen the financing structure. That happens more often than buyers expect. This becomes especially important in business-only childcare transactions involving lease obligations. Occupancy costs heavily affect DSCR calculations because rent payments continue regardless of enrollment fluctuations. If lease structure becomes too aggressive relative to cash flow, underwriting can tighten very quickly. I have seen otherwise attractive centers struggle financially during underwriting because projected debt service and occupancy costs together created limited operational cushion after closing. And sophisticated buyers usually understand this before they even make offers. Another pattern I commonly see is owners focusing too heavily on historical lifestyle benefits than normalized operational cash flow. Personal expenses, discretionary spending, inconsistent bookkeeping, or unclear financial categorization can all complicate DSCR and analysis during underwriting. Lenders usually want clarity, The clearer and more understandable the financial reporting becomes, the easier it is generally for the lenders to evaluate true debt coverage confident. I recently viewed a center where the operational business itself actually performed reasonably well, but inconsistent financial presentation created additional lender caution during underwriting because cash flow became harder to evaluate cleanly. The business was not necessarily weak, the clarity was weak, and that affected financing confidence. This is why sophisticated sellers often begin preparing financial organization well before going to market. Stable trends, understanding reporting, disciplined payroll structure, and reasonable occupancy costs all contribute towards stronger underwriting outcomes, not just stronger marketing narratives. And honestly, many buyers underestimate how emotionally stressful thin DSCR transactions become during escrow. Every operational fluctuation suddenly matters more. Enrollment dips matters more, staffing changes matter more, updated financials, pressure increases quickly. So, your homework is simple. Look at your center the same way a lender would. Evaluate not just revenue, but the actual remaining operational cash flow after payroll, occupancy costs, and core expenses. Then ask yourself whether the business appears capable of comfortably supporting future debt obligations with reasonable stability. That exercise alone changes how many buyers and sellers view valuation and financing risk. If you want a confidential discussion about your child care center acquisitions, valuations, or transaction structure, reach out to Child Care Insight. Thank you for watching. We'll see you on the next video.